I think arguably we're already cashless.
It's all part of a much bigger digital revolution.
Cash is what we use.
Australians more and more are ditching cash, and some of our biggest banks appear to be encouraging the demise of notes and coins. Are we on our way to becoming the world's first cashless nation? Hello, and a very happy new year to you all. I'm Rebecca Jones, and welcome to the Bloomberg Australia podcast. Today, Australia is at the acute end of a scenario playing out in many countries around the world. More and more Aussies are using digital payments to buy everything from coffee to cars. But at the same time, we're hoarding paper money, just in case. To make matters more interesting, the government is insisting that some businesses will need to continue to accept cash. So which is it, cash or cashless? Adam Haigh is a finance editor at Bloomberg based in Sydney, and he joins me today to unpick this complicated state of play. Adam, great to have you back.
Great to be back, Beck.
It was sometime 2020, I went to buy a newspaper during the pandemic, a real one because I'm a Renaissance woman. My fistful of coins was rejected by the newsagent. It was, Adam, the first time I'd ever really contemplated a world without physical currency, but I guess that's happening. What is happening with cash use in Australia? Can you give me some stats?
Yeah, I sure can. Have a look at this RBA data, which is the Reserve Bank of Australia, the central bank here. So going back to 2007, cash as a payment method in Australia was about 70% of all transactions, right? With the rest in credit and debit cards. Now that's come down to about 13%, with card use ballooning to 77%. So clearly it's a story of tumbling cash use in Australia over a relatively short period. A big flip in the way that people are paying for everything, really, in their daily lives. And of course, one main reason for this is that you've had this huge growth in digital wallets on people's phones, which are pretty much the main way that people pay for things in Australia these days.
Something we were not doing in 2007, at least I wasn't on my BlackBerry, and you probably had Nokia flip phone, I'm guessing?
Yeah, one of those, obsolete these days.
Motorola Razr. So one of the biggest banks last month, the CBA, Commonwealth Bank of Australia, they've done a huge backflip and scrapped a decision to start charging their customers for withdrawing cash at their own ATMs. Let's take a listen at what CBA's Head of Retail Banking Services, Angus Sullivan, had to say about that.
The changes that we made were motivated around simplifying our product portfolio. We've got a product with complete access, which has been unavailable to new customers for almost 9 years, and we wanted to make sure that for those customers who were able to avail themselves of a lower cost banking option, we could do that. Obviously, we got the comms not landed in the way that we want to, and for those customers where that change may not put them in a better position, we want to have the opportunity to be able to talk to them and make sure that we look after their needs individually.
Adam, can you step us through how this decision came to be reversed, and why was it so significant?
Yeah, it was just so unusual and such a strange turn of events over a few days. So the Commonwealth Bank originally announced the changes. It was going to impact some of their customers on some accounts. This wasn't across all accounts. And immediately, or certainly felt immediate, across social media, you had this huge blow up of reactions of surprise and bewilderment, but also, crucially, not just on social media, at the upper echelons of the government, on both the government side, but also the opposition. There was talk of why was this going on, and why had Commonwealth Bank of Australia chosen to do this at a time of, quite a lot of pressure on people's budgets with inflation still running high in Australia. So you had the Treasurer, Jim Chalmers, ending up saying that he had had a call with CBA CEO Matt Comyn. And then the next day you had an announcement that the decision had been put on ice. A few days after that, you had Comyn again being referenced in the local media here as saying that he was both surprised and disappointed to see that the change had gone out of his bank. So this was going to be a relatively minor tweak to just some accounts at Australia's biggest bank. But it was very rare to see this kind of very vocal opposition from all swathes of Australian society. And I think that really tells you so much about this debate. Is lots of people have an opinion on this. People were talking about this at dinner parties that didn't even have Commonwealth bank accounts, and obviously wouldn't have been impacted by the change here. But it goes to the heart of a lot of this discussion around, why would we be charged for taking our money out, and the broader discussion around cash and cash's place within Australian society.
Yeah, it really hit a nerve, didn't it? And, it's not like it's without precedence either. I mean, there's plenty of times that if you desperately need cash for something, you'll use an ATM belonging to a bank other than the one you bank with, and you'll pay a small fee, and you'll do that happily just so you can get the cash out to do what you want with it. But, is there a bigger story at play here about how expensive it is for cash to keep flowing across Australia, especially in, these smaller and remote towns? Have we arrived at a situation where we have banks footing the bill when they might not want to?
Well, of course, Australia is an incredibly big place, isn't it? And outside of the major cities, I mean, you just have to imagine the logistics of transporting anything to the remote areas of Australia, really, not just cash or banknotes, anything, vegetables, building materials. There is an not insignificant cost associated with that. So most in the situation with cash, most of that's done by a company called Armaguard. So they're really the main player that's responsible for the movement of cash transit, the technical services, and the ATM networks around the country. Now, Armaguard a few years ago merged with a company called Prosegur. Those two were already market leaders, and now they act as one company that has total dominance of that place in the market. And that's a company that's been struggling for some time now. There's been an inquiry into what's happening at that company, why it's struggling, and that's involved some of the highest levels of the Treasury and government, the CEOs of the major banks, very senior executives at retailers that rely on cash. And there's been all sorts of discussions and presentation of potential deals about how Armaguard could move forward from its troubles. But really, the situation today that we're in is that Armaguard has been extended a $15 million lifeline that keeps it going through to July. So by the middle of 2025, that money will run out for Armaguard. Now, importantly, it's the big banks and the big grocery firms that are paying for that $50 million to keep Armaguard propped up. So that's for now, at least. Now that runs until the middle of the year, and it's an open question, and there's very much ongoing discussion about what happens after July.
And from the stats you gave me earlier, it's clear that, Australia is very much a world leader in this move towards a cashless society. Do we have one of the lowest uses of cash rates in the world, Adam? And if so, what can we learn from other countries? And conversely, what can they learn from us about what's happening here with Armaguard?
Well, if we look at a recent report from WorldPay Global, they have some very good figures on not just Australia's cash use, but also globally, and they drill down into the numbers. So let me just give you a few of those. So Norway stands at 4% in terms of cash transaction value, so very low. Australia at 7%, China around 7%, and then places like the US are up at about 12%. So clearly Australia is among the lowest in the world. And of course, one of the main reasons for that and why Australia is such a leading example of what may happen in the rest of the world is just that explosion you're seeing in digital wallet point of service transactions. So if you think of Apple Pay, Google Pay, those kind of transactions, so WorldPay expect that those kind of transactions will double between 2023 and 2027. They will double. But it's also about the changing demographic in the way that different people pay for things. So young people are paying for things in very different ways to the older demographic. And I think buy now, pay later is the ultimate example of that. That continues to be a huge growth area in Australia, despite some ups and downs of the last few years. So I go out and buy my sofa, but I don't pay for it all in one go. I just pay for it with, quarterly installments. And that's very much the favored way of lots of young people in the way that they pay for material things. But it also, all this comes on the back of banks reducing their footprint at branches, which is, of course, not an Australian phenomenon. That's happening around the world. And banks don't want to put incremental dollars of investment into places like branches or the use of cash when they can clearly see that less and less people every year are using it. What they want to do and what they're obliged to do to their shareholders, but also to their customers, is to put money where the growth is. That's clearly not in cash use.
It's a balancing act, isn't it? And when we come back, let's take a deeper look at what all of this means for those in the business of money, the banks, and for us, the customers. And welcome back to the Bloomberg Australia podcast. I'm Rebecca Jones, and today I'm talking to Adam Haigh, Bloomberg Sydney-based finance editor, about whether or not we're about to start seeing coin purses in museum cases. Adam, against the backdrop of all of this, bank shares in Australia finished 2024 very strong. Is that just because they're good at pivoting, or does it mean that the type of legal tender we're using doesn't really have a huge impact on the underlying profit that these big banks make?
Well, listen, I think it's clear that banks know how much cash use is falling and the cost of provisioning for it, therefore, per customer is going up. So I think that much is very clear to them. But ultimately, it's not a huge driver of profit for them. I think if you look at 2024, what has been the big driver of profit continues to be these big home loan books and these business banking books that these banks have. That's where they make their money. And these banks have been some of the stock market darlings of last year. They're really strong performances across the board. And a lot of that was around the fact that investors took a view on a lot of mortgage customers who had rolled off those low pandemic era rates onto higher rates, had to give some margin back to the bank, and this overall pressure on margins at banks was starting to ease and was starting to give a bit of a positive signal. So the extent to which that continues in 2025, it's still a bit early to tell, but of course a lot of it will be down to how much the broader interest rate landscape changes in Australia. If nothing too dramatic happens to the economy and rates don't move a huge amount, the backdrop does stay reasonably good for banks.
And that, of course, leads me to ask, what does this all mean for consumers in Australia? Obviously, it's very convenient to be able to pay for things with your mobile phone, but will this pivot to digital payments make banking and make paying for things ultimately more expensive?
Well, I think sometimes consumers aren't really aware of what costs are involved. So I'll give you an example. The other day when I went to buy my kids some new soccer boots, I looked on the label, $59.99. When I went to the till and I paid using my phone, a digital transaction, I paid $59.99. So it was very clear what I had paid. But the next morning when I went to go and buy my coffee, a $5 coffee, when I tapped my phone, I was actually charged $5.29. So clearly different retailers have different ways of dealing with that and passing costs on, because there still are lots of costs associated with digital transactions. It's not free. And CEOs of major banks are very keen to stress that point. And I think rightly so. Some people don't still understand that there is even when you hand over your $5 note, there's something beyond that $5 note that's taken it to get there. And that's really what they're arguing over. They're arguing over whether they should have to stump up that money themselves or whether we should share it more broadly around society. But clearly, even with digital payments, there are costs involved, and there are all sorts of deals between merchants and retailers and banks and lots of different organizations within that equation that the consumer never sees. So there is this idea of who pays for it, but also when do we really need cash? So during times of stress or severe weather and flooding, and that's where we've seen times where communities have become isolated and people have really needed cash because electricity's down or the Wi-Fi is down and they're unable to make digital transactions. So cash really does have a place at those particular periods of time. But of course, that doesn't happen too often. So really, for banks and for the people running banks, it comes back down to what the customers need and what shareholders want. And support for cash transactions is clearly not the long-term future here.
So as we head into 2025, Adam, what developments should we be watching out for in this story?
So the main things we really want to keep an eye on, certainly in the early part of 2025, is what's going on with those ongoing discussions between banks, Armaguard, the government, how this is all shaking out and whether we can glean anything about what the future might hold after this $50 million lifeline to Armaguard ends in July. So is there a real chance that Armaguard doesn't exist in the future in its current form? That's a possibility. And any more commentary coming out of the government around how far they're willing to go with this idea that older and more vulnerable people need to be ensured access to cash, and also for small businesses too, and indeed who will pay for that. So I think that's really the main things that we want to look out for in the early part of this year on this story.
And probably not a bad idea to keep an eye on the surcharge added to your morning coffee. Adam, thanks for joining me. And thank you for listening to the Bloomberg Australia podcast. I'm Rebecca Jones. This episode was recorded on the lands of the Wurundjeri and Gadigal people of the Kulin and Eora Nation. It was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. Don't forget to follow and review the show wherever you get your podcasts and sign up for Bloomberg's free daily newsletter, Australia Briefing. Go to bloomberg.com to subscribe.